Hello and welcome to NoCast by CMUBS, the podcast where knowledge meets inspiration. I'm your host, and I'm here to take you on a journey through ideas, insights, and stories that shape the world of business, research, and innovation. Each episode, we bring you thoughtful conversations, practical wisdom, and perspectives from experts and changemakers. Whether you're a student, a researcher, or simply someone who loves learning, this is your space to explore, grow, and stay inspired. Thank you for tuning in. Let's dive into today's episode and discover something worth knowing.
Have you ever looked back at an investment decision and thought, what was I thinking? You know, a choice that felt more like a gut reaction than a smart, calculated move. Well, it turns out you're not alone. Today, we're going to dive into the hidden psychology that's really pulling the strings when you're making choices on Wall Street. So let's just kick things off with a big question. When it comes to your money, do you think of yourself as a completely rational person? I mean, really think about it. When you decide to buy or sell, is it all based on pure, cold logic? Are you like a supercomputer just crunching the numbers? Or does it ever feel like something else is in the driver's seat? You know, the old school finance textbooks love to paint a picture of this ideal investor. Cool, calm, always logical. But a really fascinating field called behavioral finance says, hold on a minute, it shows us that most of us are actually the real investor. We're driven by our feelings, our biases, and yeah, even our gut. And that's exactly what this research is all about. Okay, so if we aren't these perfect financial robots, then what's really going on in our heads? Well, this research zeroes in on some of the powerful and often totally invisible forces at play. At the core of all this is a concept they call forecast bias. It sounds a little technical, but it's actually super simple. It's the gap between what you think the market is going to do and what it actually does. This bias is basically a measurement of how our own psychology, all our hopes and fears, is coloring what we expect to happen. And what the researchers found is that this bias isn't random. It's consistently shaped by three main psychological forces. First, just your mood, how you're feeling in this exact moment. Second, your more general mental state over time, specifically looking at things like depressive symptoms. And third, and this is a big one, how you've been doing lately, your recent wins and losses. And this is where things get really, really interesting. Because by digging into these drivers, the study uncovered some truths about our financial brains that are frankly not at all what you'd expect. So let's break them down. All right, truth number one. This one completely flips a common idea on its head. What if being in a bad mood could actually make you a smarter investor? I know, it sounds totally backward, right? But it's true. The study found that when investors were in a negative mood, they were way less likely to be overly optimistic. It's like a little bit of grumpiness strips away the wishful thinking and helps you see things as they really are. And check out this contrast. A bad mood clearly dials down optimism. But what's really wild is that a positive mood didn't seem to have a major effect either way. So it suggests that while being happy doesn't necessarily make you a reckless optimist, feeling a bit sour can actually ground your expectations in reality. Okay, on to truth number two. And this is a warning for anyone who's just had a nice winning streak. This research shows just how much a recent win messes with our heads. It's like it injects you with this dose of overconfidence, making you look at the market's immediate future and see nothing but green lights. And you can see that effect so clearly here. Investors who had just raked in high profits were way more optimistic in their short-term predictions. On the flip side, those who took even moderate losses got pretty pessimistic fast. So the bottom line is, your very recent performance acts like this powerful filter that distorts your view of what's coming next. So let's get to our final truth, and it might be the most complex and paradoxical of them all. It has to do with the long-term mental state of depression. I mean, it seems like a no-brainer. We often associate depression with negative thinking, so you'd naturally expect that investors with more depressive symptoms would always be predicting doom and gloom for the market. But what the research found was just strange. While it didn't have a clear impact on short-term forecasts, what it did to people's long-term outlook was the complete opposite of what anyone would predict. This is what they call the depression paradox. The study found that investors with more depressive symptoms were actually more optimistic about the market's long-term future. The thinking here is that it might be a psychological coping mechanism called compensatory optimism. where your brain tries to manage the negative feelings of today by creating these overly positive hopes for the distant future. Now, all this stuff is a fascinating look into the human mind, but it's not just some academic game. These biases have very real consequences for anyone with money in the market. This quote from the research just nails it. Our financial predictions aren't just calculations, they're stories we tell ourselves, and our emotions are the ink we use to write them. And the impact is massive. For you and me, it means you could make a really costly trade just because you had a bad day. For financial advisors, it's a huge reminder that understanding a client's psychology is just as important as their financial statements. And for the market as a whole, when lots of people get emotional at once, that can fuel the bubbles and crashes that affect everybody. The great news is, just understanding that these biases exist is the first and most important step to beating them. This research gives us a kind of roadmap for making smarter, more self-aware decisions. So what can you actually do about it? It comes down to 3 practical steps. First, know your mood. Before you hit that trade button, just pause and ask yourself, hey, how am I feeling right now? Second, check your wins. If you just had a great run, that's awesome. But that's when you need to be extra careful. That's when overconfidence loves to sneak in. And finally, and this is the big one, trust your strategy. You have a long-term plan for a reason. Stick to that, not your fleeting feelings of the day. And really, that's the ultimate takeaway here. That line between analyzing the market and simply feeling our feelings is so much blurrier than we think. Being a great investor isn't just about knowing the market. It's about knowing yourself.
Thank you for joining us on NoCast by CMUBS. We hope today's episode sparked new ideas and inspired your next steps. If you enjoyed this conversation, don't forget to follow our podcast and stay connected so you won't miss the insights, stories, and meaningful discussions coming up next. Until then, keep learning, keep exploring, and see you in the next episode.